Hi, welcome everybody. This is Wendy Kraft. I'd like to thank you for sharing your afternoon with us. This is pretty exciting for me because I'm with a group that I have known for years, and that's Silver Spike, and I've known them since their inception, and they're delightful. It's a wonderful group. So I'm going to kick this off as everybody is loading in to Bill Healy, who has put up with me for many years. And Bill, take it away.
Thank you very much. Thank you, Wendy. It's a delight to have an opportunity to speak to everybody. Thank you for joining us. Again, my name is Bill Healy. I'm one of the founding partners of Silver Spike Capital. For those of you that don't know, we were founded in 2019. We're an SEC registered investment advisor focused on investment opportunities in the cannabis industry, particularly in the credit space. We've raised more than $1 billion in public equity capital and deployed funds across various transactions and strategies. Germane to today's conversation, we manage the first and only cannabis-focused lending vehicle registered under the Investment Act of 1940, which is a NASDAQ-listed BDC. For those of you who may be unfamiliar with BDCs, think of it as a closed-end mutual fund. For a more in-depth session on Silver Spike and our background and the opportunities in the industry, Arthur was kind enough to conduct a one-on-one with our managing member, one of the Family Office Insights webinar on July 12th. Please feel free to access that webinar recording, or you can reach out to me, Bill, at silverspikecap.com. We can give you a link to that as well as the transcript to that conversation. As for today, we are really excited. It's super timely to delve more deeply into a great opportunity anchored by our BDC, Silver Spike Investment Corp, and a significant firm originated pipeline. We're launching Silver Spike Private Credit 2, details on which, in terms of terms, I will summarize after Frank's discussion. We're targeting first lien, senior secured floating rate debt with collateral and cash flow coverage and lender friendly covenant packages at significant unlevered premiums to traditional middle market lending rates. So today, it's our objective to convey to you how differentiated and exciting this opportunity is, why now, and why Silver Spike. So to that end, I'm very, very pleased to introduce one of our partners at Silver Spike that runs our credit platform, Frank Kotsen. Frank, the floor is yours.
Thanks, Bill, and thanks, Wendy, and thanks everyone for joining us today. First, to start off, so my name is Frank Kotsen. As Bill mentioned, I'm the head of credit at Silver Spike Capital. And there's three main things I want to communicate to everyone today on the call. So first, I wanted to mention that the legal cannabis industry is really enormous and is growing very rapidly. It's now been approved for medical and or recreational use in nearly 40 states, which covers the vast majority of the US population. And legalization is in fact favored by the vast majority of US citizens. The legal cannabis industry is over 30 billion in revenue in retail sales alone, and that's projected to be up to 100 billion revenue business in the next decade or less. Note, this 30 billion in revenue is only the retail sales side. It does not include business to business revenue, which of course is multiple billions. My second point is there's a tremendous opportunity to achieve outsized returns lending to this fast growing industry. And this is one of the best opportunities I've ever seen in the direct lending private credit space. There is right now an incredible supply demand imbalance of debt capital in the space. So huge demand for debt capital and not a lot of supply of it. So lenders can achieve outsized risk adjusted returns making loans in this space. My third point is that Silver Spike Capital is the right investment manager to select if you want to take advantage of this opportunity. And specifically, as Bill mentioned, we're launching our second private credit fund, and that's what we're here to talk about today. So let me take you through each of these 3 points one by one, and then we'll get into some questions. First, if we could put up the first slide, we'll drill down a little bit into the cannabis market. So as you can see from this slide, retail revenues are over 30 billion, projected to grow to 100 billion. Really, it says in the next 8 years, it's called in less than a decade, and that's been growing at a 15 to 25% CAGR. And as you can see from the slide, that is near the current market for beer and tobacco in terms of revenues, and above that of spirits, and far above that of wine. So it's a fast growing industry. And as I also mentioned, this does not include B2B revenues. And also, this is an industry that's really important to the states. As I mentioned, it's legal in one way, shape, or form in almost 40 states now, and many states will have referendums upcoming in the upcoming election about legalization. And it creates a tremendous amount of jobs and taxes. In fact, I've read recently or earlier this year that the state of Massachusetts had derived more tax revenue from cannabis than it had from alcohol. As I said, the majority of citizens and states support this, and for many reasons, including reducing the size and the inherent risks of the illegal market, it has broad-based support for legalization. So next, I want to go to slide 2, and I want to drill down on the private credit direct lending opportunities in this space. So this slide is illustrative. It's actually the direct lending index doesn't get published as frequently as the other indices do. In fact, the high yield index gets published every day. So there's a little bit of a lag because this is the most recent data that's available. But it does show that the 3 major types of lending that traditional leverage finance people look at, high yield lending, leverage loan lending, and direct lending, all kind of yield in the 7%. It's more closer to 8%, 8% now. So it's in between 8 to 9% rather. The cannabis lending premium does exist, and most of the loans that we're talking about are in the mid to high teens, so nearly double the yield that you would get from traditional leverage lending. And hopefully I can convince you later on in the conversation today that in a lot of ways, I think there are fewer inherent risks in terms of structure, in terms of LTV, in terms of leverage than you would get in, for instance, a traditional high yield bond. And then lastly, I want to drill down to slide number 3 and talk a little bit about our team and why us. And this is frankly where I'll spend a few minutes. This is the most important slide because this is really what we're here to talk about today, is why we're uniquely positioned as an investment manager in this space. So, frankly, our team and founding partners consist of founders, operators, and managers of businesses in the cannabis industry, plus investment professionals, including folks who have up to 25, 30, 35 years in the space in credit analysis, credit investing, credit trading, credit lending, et cetera, across dozens of jurisdictions in both emerging markets and developed markets. And the reason I mentioned dozens of jurisdictions across many countries is that, in the cannabis space, every state, and as I mentioned, there are almost 40 states that have some form of legality, has its own set of rules and regulations. So I think it's really important to have people managing and investing your money in this space that are facile and are used to different sets of rules and regulations in different jurisdictions. At Silver Spike, we are an SEC registered investment advisor. We're dedicated to the cannabis sector, unlike some folks who come in and out of it. And specifically, we're dedicated to providing bespoke private credit solutions to the industry. Scott Gordon, who you see on the left, is our co-founder and managing principal. He has about 35 years of experience running international special situations businesses, trading, investing, lending, running a multi-billion-dollar family office, but also investing and managing in the cannabis industry for many years. He co-founded Papa & Barkley, which was ranked by Headset last year as the #1 cannabis health and wellness brand in the US. And Scott sits on the board of that company. In addition, Scott also sits on the board of Weedmaps, which is a software as a service technology corporation in the cannabis industry that is used in, I believe, over half of the dispensaries in the country. Last year, Silver Spike Acquisition Corp made a take public acquisition of Weedmaps, and at $580 million, wrote one of the biggest equity checks ever written for a cannabis company. And my background briefly is I worked with Scott at Bank of America a while back. I spent almost 24 years at Merrill Lynch, then Bank of America, then Bank of America Merrill Lynch. When Bank of America bought Merrill Lynch, mostly focused on the credit businesses as a credit analyst, a trader, head of global special situations, head of loan trading, head of credit trading. And from 2014 to when I left in early 2020, I was head of the global credit trading businesses, which encompassed everything in credit from investment grade to high yield to loans, structured credit, CLOs, special situations, and credit asset financing. So as running these global trading businesses, in that capacity, I managed a balance sheet of up to $50 billion. But from the lending side, one of our key success stories was we built a nearly $20 billion lending business to both broadly syndicated and private credit direct lending portfolios. And those 5 years I spent with my team, digging deep into that, gave me a really that direct lending space and the broadly syndicated lending space, of which I had already had a decade of experience or more in, gave me a unique window into the private credit and direct lending space, is what we're talking about today. So at the bank for many years, I managed dozens of credit analysts and sourcers of loans and special situations debt globally. And here at Silver Spike, I built a credit team using best practices that I learned over 2.5 decades in the capital markets. And then if we could put up slide 4, I'll just talk real briefly about the Silver Spike kind of network and what we're dedicated and the history of the firm, what we're dedicated to. We've raised 4 public companies. The first made the acquisition of Weedmaps, which I mentioned earlier. The most recent public company in a very difficult IPO market in February of this year, we raised the first ever SEC approved, NASDAQ approved, cannabis-focused 1940 Act close-end fund, which is a business development corporation. It's called Silver Spike Investment Corporation. Ticker is SSIC, and it's traded on the NASDAQ. Silver Spike Capital, who we represent, is the external manager for this BDC. And this BDC is a direct lending vehicle. And what we aim to do in our new launch, which we're introducing today, is similar: direct lending, private credit to the cannabis industry. It just happens to be in a private, non-publicly traded format. And I would suggest that having multiple lending vehicles in the space, such as our first and now our second, can potentially create a virtuous cycle. The more scale we have, the more large deals we can see and lead and participate in. And let's take down slide 4. And I think I'll take a pause for a second, Wendy.
Get a drink of water. Yep, absolutely. Is it okay if I ask you some questions? Would that be all right?
Yeah, that'd be great. Thank you.
Okay. So in broad terms, what does a typical loan look like?
That's a great question. It's really interesting how the industry has coalesced around this type of structure that I'll describe, with, of course, tweaks and variations. A typical loan would be first lien, senior secured, with a pledge of all available assets. We typically have very low LTV versus what people are maybe familiar with in the leveraged finance market, like high yield or leverage loans. So the typical LTV we've seen as low as below 10%, and usually not much more than 30%. Typically very low leverage, for instance, 2 to 3 times debt to EBITDA. The IRRs would typically be mid to high teens. And one benefit of lending in this space versus like your traditional leverage finance space is the amortization typically starts in the 3rd year. They're typically 4 to 5 year loans. The amortization starts in the 3rd year, and it's usually significant, like 10 to 15% of the loan initial amount. And that helps de-risk the loan. So when you get to the end of the loan, you're not sitting there with 100% maturity. The loans tend to have very good call protection and also have very strong lender-friendly covenant packages, which does not exist anymore for the most part in leverage loans.
Fantastic. And for everybody in the audience, I see that questions are coming in. I will get to them. I just have a few more I want to ask, and then I'll start answering the questions you're posting on Q&A and chat. Frank, can you tell everybody about a specific loan to the extent you can that you've done?
Sure. Yeah, I'll give you some broad parameters. So we, it is a public vehicle, so the information that I say will be in our 10Q. And when I say it is a public vehicle, that's SSIC that I referred to before, our first private lending vehicle. So an example was earlier this year, we announced that we co-led a loan, which is up to $170 million in size. It was for Shrine Group, which is the owner of Steezy. As many people on the call will know, Steezy is ranked by some is the #1 global cannabis brand by some of the ranking services. And the information can be found in our 10Q, but it conforms to some of the things that I spoke about before. It is one of the largest private cannabis loans ever written. We helped originate and underwrite it, and then we helped allocate it to other investors. It was a tremendous win for our platform, and certainly opened the door, I think, in a lot of ways to the, to people's understanding of the opportunity and size and scale of the opportunity, I would say.
Fair enough. I kind of want, one of the slides you had showed us said that typical loan returns, and you had said 7 to 8%. So there was this article in Barron's over the weekend that said 8% is great. But you had said, that there are better returns than that. So can you kind of talk about those differentials and go back to that just a little bit?
Yeah, absolutely. I think that's a really important point. Maybe if we could put up slide 2, I think that was the slide that had the
Yeah, that was the one I was talking
spreads.
about.
Great. While we're trying to pull that up, I'll start to let's see. I'll start to address that question. So really interesting, everybody's obviously laser focused on the markets. The markets have had an extreme dislocation this year with all the central banks, raising rates, especially with the US Federal Reserve being aggressive. I mentioned that these numbers are quarterly numbers because we wanted to make an apples to apples comparison. But we actually, we follow this very closely given all of our years of capital markets experience. And what we found was last year, September at the lows, the high yield index was yielding less than 4%. And actually, as of today, it's yielded more than 9%. That's an effective yield. And so it's a little bit higher than this chart. So given this dislocation, we have the high yield market has now moved about 500 basis points wider. So looks interesting. Barron's says it's a good time to buy high yield at 8 or 9%. Barron's has a lot of, sophisticated, smart folks there. But we think it's a great time to lend to the cannabis space with better protections, better covenants, other de-risking characteristics like amortization, which I mentioned, which you probably wouldn't find in these high yield bonds. Similar maturities, shorter maybe, so less duration risk. And in a lot of ways, almost, I would say at least 1.5 times typically, but almost up to 2 times the all-in yield you might get in the high yield space. So I think it's a really important, I think everybody is a little, folks are a little bit concerned about the volatility dislocation of the markets, but the smart folks and the sophisticated investors are saying, okay, where do I take advantage of this dislocation? And specifically what industry, what product, what vehicle, and I think that's what we're offering and talking about today.
Fair enough. If we can go take the slide down, that would be great. So the family office that I run, Frank, is primarily a real estate family office. And when we take a loan, we secure it with the building, i.e. if you don't pay, you get the building. So what do you do about collateral in this scenario?
That's a great question. That's a frequently asked question. So first liens are first lien senior secured with basically a pledge of all available assets. And that would include real estate, unencumbered real estate, the pledge of the equity, which owns the licenses. Oftentimes the licenses are one of the most valuable assets of these companies. And the equipment as well. Note that there's a key difference between what we do and the REITs is that we can do real estate lending. That is definitely in our remit. So people ask us that a lot, like, hey, can you lend to the real estate, cannabis real estate? Absolutely, we can do that. We will do that. But we can do a lot more than that. And what we found is, the productive capacity of companies that have grown and have succeeded in this space in terms of the debt capacity far exceeds that of the real estate value. A company might start with 10 or 20 million in real estate. Oftentimes they've already done a sale leaseback or they have a first lien mortgage against it. But if a company is imagine a company is generating 20, 25, 30, 50 million in EBITDA, that business on a cash flow basis can support a much bigger loan than just the value of the real estate alone.
Fair enough. And you brought up REITs. So since you opened that door, I'm going to ask you, how does this kind of compare to those publicly listed cannabis REITs?
Sure, that's a great question. It comes up a lot. We thought a lot about should we be there's a few cannabis REITs, 2 or 3 of them that are traded publicly, a few private ones. We thought pretty hard about this a couple of years ago. Do we want to do the REIT form or the BDC form? There's some similarities, although the REIT, the BDC is a 40 Act fund. The REIT is not, but they both pay quarterly dividends. They pay the bulk of their earnings out. But basically, what I mentioned before is we just think the total addressable market size, by very definition, should be many times the size of what's available to REITs from the real estate collateral, and that's true in all industries. That's not specific to this space. But I think the lending in this space followed a typical evolution, right? People first just borrowed money from friends and family, when this nascent industry, when the states first started legalizing it. And then over time, some regional banks started getting involved and some credit unions, and they would lend a little bit. Friends and family might lend against the real estate as they bought real estate. They did a lot of sale leasebacks also. Now we're in kind of the third wave of lending in this space, which is, okay, friends and family, then real estate lending. Now we're really talking about corporate cash flow lending. We're talking about some companies that generate significant amounts of EBITDA, big numbers in revenue. You see how fast the industry is growing. So really at a state, and we've seen that really at an inflection point in the last year or so, where these companies, many of them can support debt against their cash flow as opposed to just against hard assets.
So how do you find the deals? Where's the sourcing?
It's a great question. It's really near and dear to my heart, because when I was at the bank, we had dozens of people globally working on sourcing loans, loan portfolios. We're kind of known for that. I think that what's important here is we are one of the few investment managers dedicated to this space. We have an incredible network in this industry, and I'll give you an example. Through our sponsor company's purchase of Weed Maps, we interviewed just under 100 companies, and there were probably a few dozen of them were very good, strong potential candidates for a lending business. So what we do in other parts of the Silver Spike kind of topco gives us, unique insight into the industry. We use our best practices that I've learned over decades at the bank to identify, track our opportunities. We leverage our unique network and our reputation and our access to capital, and really our unique insight into the industry from an operations perspective, but also a debt and equity capital markets perspective. And really companies are happy to take our call. We partner with companies in the origination process. We spend an incredible amount of time understanding their business, much more than many people can even understand. The competitive dynamics in the markets in which they operate are very important to us. Understanding their management teams. We spend a huge amount of time looking through their business plans with them, understanding their financial forecasts and their modeling. And I really think it's safe to say they view us as trusted partners, even the companies for which we do not end up making loans to. Our reputation is very important to us. We invest a lot of time, but of course we have a very high rejection rate. The vast majority of the deals we reject. And so deals that look good on the surface, we dig down deep, and ultimately we don't always, write a ticket. We don't always make a loan to a company that might not be ready for it. But we really do focus on our kind of proprietary sourcing capability, and we track all the major companies in the major states, in all the states. And we have a regular dialogue. We go to the conferences, we do webinars, we're on calls, nonstop. Our team, various members of our team are on calls with companies to talk about and when we do loans like the Shrine loan, we get a lot of press, we get a lot of calls from that, and people go, oh my God, that's one of the biggest private loans ever done in this space. What are you guys up to, and how can I talk to you about a loan?
Well, speaking of that, so what are the investment, the underwriting processes that you maybe did for that loan, or you would do for a loan?
That's a great question. It's really detailed. Maybe we could pull up slide 4 and we can walk through some of the elements of our underwriting process. Because this is something we've spent a tremendous amount of time before we did our first loan, before we raised our vehicle, was really thinking about all the best practices we've all learned in our careers. And so I apologize, a ton of detail on this slide, but I'll give a real high level. So we have an 8-step detailed underwriting process. It includes the sourcing and origination, which we just spoke about. Then from there, if we find something that looks, appealing, we'll have an initial credit review, and then an initial IC committee meeting to discuss it, to see if it's something that we want to potentially allocate time and potentially allocate capital to. From there, we would execute indicative term sheets. We would conduct detailed due diligence if things are going, the right way in terms of us being interested in pursuing the loan. And then we have a final investment committee meeting where we require 100% unanimous approval. And then lastly was the closing and the monitoring. Our loan documents, the result of this, are incredibly detailed. unlike, participants maybe in a high yield market where you kind of get the loan document, the bond document that gets given to you, we create our own documents. And they're incredibly detailed. We analyze every aspect of the loan and we use the best practices in all aspects.
So let me ask you this, Frank, because I see on here on this sheet that I'm looking at, you have due diligence, you have final due diligence. How do you do that due diligence in this space? And I'm asking you because I'm coming from real estate.
No, that's a great question, because it has some similarities, of course. But let's flip to slide 5, and I can walk through the due diligence. Now, this is illustrative of all the different steps, and it really is. When people ask, why does it take long to underwrite credits in this space? It's a complex industry. I mean, this is why we love it, right? And this is why it makes it barriers to entry from a lending perspective are high because of the complexity. This is the most detailed credit due diligence process I have ever seen. When my team built this $20 billion lending business at the bank, we were lending to portfolios in every industry except not this, of course, because nationally chartered banks don't lend to this industry. And so I've seen every industry. We've seen pretty much every industry. This is more complex than anything I've seen. So we think we've built a really great mousetrap, just taking our best practices and putting in that. So you can see on this slide, the process consists of 150 distinct due diligence line items. And I laugh because it is really detailed. It's across 12 key categories, which includes, of course, financial documents, organizational documents, business plans, background checks, liquidity, regulatory issues, which is a big part of the complexity in this industry, corporate governance as well, and taxes. And we highlight taxes, just one illustration of, I know there's a lot of detail on the slide, so I apologize, but we highlight that because there's some unique tax characteristics in this industry, which we don't have time to dive into today, but just as there are unique regulatory and licensing and entitlement aspects of this industry that you don't find in most other industries. And they really require an extra level of due diligence not seen in frankly, in any other industry.
How do you build a remedy into the loan documents? Because I don't think they can do Chapter 11, right? So
That's right.
How do you handle that?
Yeah, no, that's a great question. It comes up a lot, and we think we have, given our extensive kind of restructuring and special situations experience, we think we have some special sauce in this space. There's several options other than federal bankruptcy available to lenders in order to maximize recovery. Look, the main thing I'll say to preface this is we try to avoid ever getting into the situation, and the way we do that is we lend low LTV. We lend a low leverage. We only lend to companies that we think can support the debt, even in a stress scenario. We have amortization that I mentioned that most, leveraged loans are not going to have starting in the third year. So we really try to get ourselves in a position. Oh, and we really manage the use of proceeds of the loan. So we don't do what they do in leverage finance, where we give, the money and then it gets used for a dividend recap. It goes up to the owners, or that's not how it works. We give money, and for the most part, it's to be used to reinvest in the business. There might be refinancings of existing debt, and if it's not, it could be used for growth capital, for M&A. I didn't mention that before, but so we do many things. And I know people sometimes say, yeah, but how do you handle the bad cases? And what I really emphasize is we try to avoid the bad cases. And I think we can do that because there's just a massive supply-demand imbalance. But let me get to the second part, which is how do we handle the remedies? So we have several options that you can use to maximize recovery through the use of state law remedies or non-bankruptcy liquidation. State law is really important. We don't talk publicly a lot about how we do it, because I think a lot of the lenders in the space, because we've seen publicly some of these loan documents, a lot of the folks just don't address it. I think they're not aware of how it works in different states. Maybe they don't think about the question that you asked is, what would you do if you ran into a problem? So we don't like to tell everybody how to do it, but eventually, loan documents get passed around and people will figure out that there are ways to do it right. And I think in a lot of ways it hasn't, folks, prior have not even thought about it or haven't done it properly. But we've worked with great counsel, several different legal counsel that have thoughts on this. So there's state law remedies. There's obviously the first case is company management is often eager to work out and can benefit from a consensual workout. So we try to align our incentives with a company so we're not going to be in a position that's opposed to them, that we're going to try to make them successful, and we're going to work a consensual workout. That's always the easiest because it doesn't require like lots of legal fees and all that. So all of our loans will have covenants that give an opportunity to bring management to the table early and work something out that avoids a tricky situation. And I don't think a lot of people do that. Like, we want to get, if there's a problem, meeting a covenant or something, we want to get there early and figure out how to address it and have enough cushion that we're still okay, right? What you don't want to do is make a loan that as soon as it trips, you know, you're in a contentious situation and you're going to have a hard time getting your money back. Next, we may build into the loan documents that we can appoint a state court receiver that could obtain control of the business with an aim to either liquidate or reorganize, depending on the situation. We may use an assignment for the benefit of creditors, which allows us to liquidate assets to pay off obligations. Of course, we'll have traditional remedies that might be available to mortgage lien holders under applicable state law or secured creditors under UCC laws. And then lastly, as I mentioned, you know, we want to be very specific that we address these issues and have that we do it early as opposed to waiting till when there's a problem.
So what happens to your market if safe banking passes? What happens to you there?
Great. It's a great question. So one we talk about a lot. So you know, sometimes people think, oh my God, are all the big nationally chartered banks going to jump in and start lending this space? And I would say, first of all, no, and for an obvious reason. We're talking about where we think the opportunity is. Private credit is a huge market. It's over $1 trillion, $3 trillion, $5 trillion asset class, something like that. And that's what we're talking about. And the banks, for regulatory reasons, have largely left that space. And that's why you see alternative asset managers being huge in the private. So by definition, banks don't even do this in other industries. So we're not worried about nationally chartered banks getting in. We have seen a few state chartered banks and credit unions lend in the space. If it does get passed, there'll be a lengthy, I think it's 180-day comment period. There will be, beyond the 180 days, there will be years of ambiguity about how interstate commerce will work in this space. And I think that's a really important point. If this were maybe 5 years ago, you know, and they legalized it federally and said, okay, interstate commerce is going to exist everywhere. Okay, there would be winners and losers, right? There are certain states that we know it's easier to grow an agricultural product because of the weather. But I think the kind of horse has left the barn on this one, which is, I don't think I mentioned how important revenues are, cannabis revenues are to these various states. I think it's going to be years, even when even when SAFE passes, even if and when federal legalization happens, it's going to be years before they sort out how does interstate commerce work. Because states that produce very cheap biomass are going to want to ship their biomass to states that have, you know, very expensive biomass, and those states are going to say no, thank you. We don't want your product here. So I think there's going to be confusion for multiple years there. And every state has its own set of regulations by now. And the other thing I would say is it's incredibly complex space, in many different aspects, operationally, legally, and regulatorily. So all those different steps, those 150 due diligence steps that I mentioned, those are not going to go away, right, if SAFE Act passes. We welcome more lending competition over time. We believe being early on and having all these processes and procedures that we've created will really give us a lasting competitive edge. And no matter where spreads are, no matter how competitive, no matter how big the market continues to grow, we're going to grow with the market, and we're hopefully going to continue to be a leader in, you know, structuring complex bespoke credit solutions for these companies.
I have one last question, and then I'll, with your permission, turn it over to questions from the audience. But I will ask Bill, if he's still monitoring this, if he could enter both of your emails into the chat for folks that they have them. So my last question, and then I promise I'll shut up, is how does this really compare, this opportunity compare to your publicly listed traded BDC?
That's a great question. So the BDC was our first direct lending fund. It is public. It's publicly traded, so there's daily liquidity. This will be our second private credit vehicle, and it'll be private. So it'll do a lot of the same types of things. This vehicle might have more flexibility. For instance, the BDC does not own equity or warrants. It's possible that warrants sometimes could come with these loans. We haven't, we won't do it in the BDC, but we could do it in this product perhaps. But some people like to be, different investors like to be in something they can trade on a stock exchange every day. And some investors just like to have something private where they can put it in, get their quarterly distributions once they start to be paid, and don't want to have to look at it on a screen. And in fact, given what's happened in the markets in the last year, I could kind of see why people might prefer to be in a private vehicle. The markets in debt and credit, have been very volatile, as you know, and dislocated in the past, 9 months.
Okay, and again, if you could type in your email to everyone so they can see it and get hold of you. Bill, I think you wanted to have a comment before I start taking Q&A questions.
Yeah, thank you. I think we could just really briefly just talk about the terms here, and then we'll get to the questions because I know there's still a few. It's fairly straightforward in terms of the key terms. It's going to be a domestic structure. The management fee, there will be a founder's share class of 3% one time up front with no recurring fees thereafter. There'll be otherwise a standard management fee of 1.5%. There'll be different incentive fee structures for the founders class and the standard class, a minimum commitment of $500,000. And again, which I think is fairly traditional in these sort of structures, there'll be a 2-year investment period commencing after the final close, then allowing for recycling of all principal during the investment period. There will be quarterly distributions commencing during the investment period, and we're targeting a 4-year harvest time period in which for all interest and principal received will be distributed quarterly to the LPs. Co-investments, there will be pro rata co-investment priorities for LPs with 5 million or more. We'll briefly talk to that. There could be and will be co-investment opportunities in the space as well. Frank may address that briefly when he talks about the BDC. Quarterly reporting and our legal counsel stated there. And again, just sometimes it's important to just restate what the fund objectives are. Look, we think there's a great opportunity for uncorrelated risk-adjusted returns here, as Frank outlined, particularly when you think of other alternatives in private credit in terms of the gross unlevered IRRs that we're targeting. With cash distributions and of course always with the objective to preserve capital with the types of loans we're making. So I will type in our emails, but anything related to the fund or anything else for that matter, if you want to have broader conversations about the industry, about our platform, please feel free to send me an email at Bill. That's silverspikecap.com. That's Bill at silverspikecapital.com. So I'll stop there from my comments, and then with a little time we have left, why don't I turn it back over to Wendy and Frank to hit the questions that people have shared.
Okay, Bill, can you take down that screen if you could? Thank you kindly. And if you could type in your email for everybody. I'm just going to take these as they came in, folks, and we'll try to get to all of you. Please discuss the pace of capital deployment since SSIC IPO'd in February, any issues which have impeded rapid deployment of capital, and how the investments in the private format will differ from those in the BDC, which we kind of answered, but go ahead.
Sure. Yeah, I'll take the last part first. There will be a lot of similarities, although I mentioned, we can't have warrants in the BDC. That was an SEC rule. In terms of capital deployment, it is a public vehicle, so I can't really comment on anything that's not been filed publicly. But we did the loan that I mentioned to Shrine in our first full quarter. So we did the IPO in February, And that was a partial quarter, right? Because the end of the quarter was March. So our first full quarter was the quarter that followed. We did the Shrine deal and we did a PharmaCann deal. That's all from our 10Q. Beyond that, I can't comment because we haven't, because those are the most recent results we have. And in terms of issues that delayed deployment, no, I wouldn't say we've had issues. I would say we're being very measured. I mentioned all of the underwriting steps that we follow, and we're capital markets people, so we're very cognizant of what's going on in the markets, and we want to make sure that when we do loans that we get paid the right risk-adjusted return for them. And so that's what we're focused on. We're focused on making sure that we're getting the right spread, given that spreads are wider, and also that we're looking to underwrite credits where the company can support the debt. And what we've seen is, people want to get, as a lender, 20%, but they don't always analyze, can the company actually pay something like that? So in other words, and we've done this in deals today, we'd rather, get a 15 or 17% gross IRR and given the market dislocations, have it less levered or have more, covenants or something. So I would say, I don't see spreads. People ask this a lot, or spreads, if high yield goes 200 wider, are you going to write loans at 20 or 22%? No, I don't see that. I would much rather, we have to underwrite loans that companies can repay. And so we'll probably just, underwrite loans with less leverage and less LTV.
Okay, and just for, for a timing perspective, we have 13 more questions. So sorry,
Okay.
guys, we're
All
going to
right,
be
so
a
I'll
little
try to go real
succinct on
fast.
them. Yeah. Are the public and private vehicles going to co-invest in deals? Are these loans typically to asset-light companies, or do they typically have easily sellable real assets?
Yep, they may co-invest together where legally appropriate. Covenant light, was asset light. So it depends. It's a wide, I mentioned these are more cash flow type loans. So we will get a first, we take that into account in our evaluation, right? We'll get a first lien on everything. If company A has real estate, company B does not, they have the same cash flow. Of course, we're gonna, have better terms, provide better terms than the company that has hard assets. But there's a wide range of the level of assets. And then people talk a lot about what is a license worth? We monitor that state by state. We track that. We consider that real value. But typically, the way you get the value from that is having a pledge of the equity that owns the license, and we take into account transfer of license issues and all that state by state. It's very complex, but let's go on to the next one. I think I got most of that one.
Okay, Mr. Walker is asking, what percentage of cannabis enterprises comprise your origination base? What is your approach to origination and default rate for initial vehicle?
Okay, so I mentioned it, or you talked about the approach to origination. What was the first part of that question?
What percentage of cannabis enterprises comprise your origination base?
So that we don't do it on a percentage basis, but to give you an example, we have read that there are over 60,000 cannabis companies. There's probably only several hundred, so that's a very small percent that we'll even dig into. We have analyzed, we have seen several billion of potential opportunities, and we do have a live pipeline of potential opportunities that totals to be over $1 billion, just to give you a sense of the scale of the opportunity. All right, let's take the next one.
Okay, your biggest concern looking out 6 to 12 months?
Competition. I would say, a lot of companies, got funded and borrowed from friends and family and et cetera when rates were low. And we're looking at what's going to happen with the economy and how's gas prices going to impact the consumption of cannabis, and is it going to impact consumption, or is it going to impact wholesale or retail prices? And then the other ongoing concern, that's more of a macro concern. The other ongoing constant concern is regulation. How do states change the regulation over time? We heard a lot of lenders saying they would only lend to limited license states. And, we are concerned about states that don't have a lot of competition, that where the state could change the legislation and then add a lot of licenses. And then where you thought you had incredible margins, you're at risk. So we don't necessarily buy that you only go to limited license states. We look at all states and we take all those factors into account. Next question.
Okay, next question. SSIC priced at $14. Why is it trading at such a substantial discount at this point? Have there been credit issues? What is the present yield at the current price of $10.25 or so?
Okay, so I can't say why it's traded a certain price, but it is the first. I think this is an important point. SSIC was the first BDC done in, I think, 18 to 20 years, something like that we had heard, that had a pool of capital that wasn't already deployed. And so that may or may not be a factor, but I think people look at BDCs to get yield, and we're very measured in how we deploy the capital. So we haven't announced a dividend yet. But the dividend is really, in some ways, not up to us, right? The dividend has to be, the BDC rule is you have to pay out 90% or more of your earnings. So people ask the question a lot, like, what's your dividend going to be or when you're going to announce it? I couldn't tell you if it's a public company, so I couldn't tell you on a call like this anyway, even if I wanted to. But B, it's not really up to us so much. I mean, we'll have a little flexibility in the timing of it on an, in an annual basis or something like that, but it is a pretty set rule. But it's hard, I can't really comment on why the stock trades where it is. But our hope is, as we deploy the capital and as we can declare meaningful dividends, people will say, look, remember in the direct lending space, people lend. I showed the slide before. People lend at 7.75%, 7.5%. Now maybe a little bit higher, maybe it's 8 or 9%. We're doing loans that are twice that yield. The way traditional BDCs get their dividends of 10% per annum or whatever they are, I'll just make up a number, but I've heard they're in that range, is they borrow. They have fees and then they borrow. If we're lending at almost twice the yield of a traditional BDC, the math would just tell you alone that we could have a higher dividend even without leverage. And then if there's leverage, and as we mentioned, and we were doing the IPO, we hope to have some modest leverage on the vehicle. We haven't announced any leverage yet. We have not had any credit events, though. There has been, no credit event that would have, driven. Let's just say we haven't had any credit events. So.
Okay, I'm going to move on because they keep coming in. We're getting slammed. So I'm going to ask everybody, if you're writing a question, don't make it a 3-part question. Okay.
Right.
So
and don't repeat the other question. Oh, but they won't know. So okay.
So Mr. Wong is asking, is the private investment pari to the listed product SSIC? Fees are the same. If so, why not just invest in SSIC?
Oh yeah, as I mentioned before, they're just two separate vehicles. One will be public, one will be private. The new vehicle will not, some people just don't want to see it on a screen every day and they just want to have a private investment. The new vehicle will have some differences. It'll be locked up for a certain number of years that Bill mentioned and all that. So those are the main differences.
Okay, and Mr. Gold, again, have you had any issues finding administrators or traditional banks that will work with you?
No, and in fact, we've developed a little bit of a network. There are some banks that have been lending in the industry in the last year or two. They're mostly, it's actually funny because Wendy, you were talking about your real estate background. They're more traditionally looking to lend against the real estate side of the business. And also there's some banks, they're all state chartered banks and credit unions, as far as I know. The national charter banks haven't done it yet, which is an opportunity, right, for us. But some of these banks have also provided leverage to some of our competitors, some of the other lenders in the space. And so that's actually a potential, and we've spoken to one or more of the banks that are lending to lenders in the space as to get a potential credit facility. So there is more activity than I think a lot of people realize coming in the bank side. It's not a lot, it's a handful of banks, but it's good to know.
Okay, Aaron Gorman Kirk is asking, how do we get in front of you? Do you assist social equity owners with any particular programs? Thanks.
Yeah, so we don't like directly assist social equity owners, but we have found that the companies that we work with often own, or co-run certain businesses with social equity owners. And so I think we're impacting, hopefully positively, the social equity folks indirectly by providing debt capital to folks who are working in concert with social equity license owners.
Okay, I have a couple of questions from Mr. Gold, so I'm just going to take them kind of out of order. Are you typically the sole lender on some of these loans that are syndicated?
So if they're syndicated, no, because by definition, Shrine was an example. Our vehicle was less than $100 million that we raised in February, but Shrine was up to 170. So kind of by definition, I mean, look, that's part of the reason we want to raise this new vehicle is there's a tremendous opportunity. We see loans 25, 50, 100 million and up every day. And so we like to be with bigger companies that are in multiple states because we think there's good opportunity. We can, you have some diversification. And so we'd like to be in some of the bigger loans, but we find some really excellent smaller companies as well. And so it's pretty exciting. But yeah, I would say, unless it was a small loan, just given the size of our current vehicle, we would be unlikely to be the sole unless it was a very small loan. But over time, we hope to, if we had enough capital, there are loans that we would have completely done the whole thing and taken it down for them. And by having multiple vehicles that can co-invest in the same, perhaps SMAs as well, we hope to be, growing our presence as a sole lender. I would say we're very, even if it's syndicated or, certainly if we lead it, of course, but even if we're working with other folks, we're very active. We're very involved in the structuring loan because we have very, very strong opinions, and we won't participate if we don't think the right protections are in place for our investors.
Fair enough. The next question comes from a very dear friend of mine, Adi, who's asking, how does SS Silver Spike differentiate itself from its competitors, notably Polaris and Chicago Atlantic?
Sure. I'll say a couple of things, and then maybe Bill might have some thoughts. But I won't pick any particular competitor, but I would say broadly speaking, a lot of lenders are doing real estate only, which we're not. I would say we're very dedicated to the space, and we've done things across different elements, not only in the debt and the lending space, including I mentioned Scott had founded and operated businesses. We've done some SPACs, including the acquisition of Weed Maps. But Bill, I don't know if you want to jump in at all to talk about differentiation.
Yeah, no, look, I would just say, I'd just say at some point, Wendy, the emotional, physical scars we have from 35 years of investing are going to help us at some point, right? So, we're in a new world now, and we actually think that our experience, as Frank outlined, sort of speaks for itself, and I think equips us in a very strong, competitive way to be very good stewards of capital, no matter how volatile the environment becomes.
Fair enough. Our next question, let's see, given the different incentives, how will you avoid conflicts of interest about whether to put a loan into the BDC versus the private vehicle?
Yeah, Frank, I can take that really quickly too.
Go ahead,
So I mean, this is not uncommon. There are a lot of managers out there today that have public vehicles like BDCs and have private vehicles behind them. So like any good SEC registered fiduciary, we'll have very clear processes outlined regarding what will be appropriate for each fund. It could be weighted. There won't anybody that has concerns or issues or feel are free to reach out, and we'll discuss that in greater detail. But it's not uncommon. It won't be an uncommon feature or quote unquote issue for us to address.
Fair enough. And are management fees on committed capital then on invested after investment period?
Yeah, so it's committed capital is not charged a management fee until the capital is called. And again, I just want to make a reference. I want to reference the difference is in the founder's management fee, which is a one-time upfront only. There'll be no management fees related afterwards. But on a traditional one, management fees will be generated or charged on capital that we actually call.
What is net target IRRs and MOIC?
Yeah, at this point, it may change. But
Frank, I think there you go.
Oh,
sorry, you were muted. You're back on.
Okay, sure. Yeah, at this point, I'll take this real quick, Bill, and correct me if I'm. At this point, we haven't. We're really looking at gross because we we don't know yet, what available leverage at what price is going to be available, and that will impact and like I said, our target is a low leverage vehicle. But at this point, we're really focused on gross returns, and you can just do back of the envelope. Like you can take our fees and adjust it for that. But I would say safe to say with where spreads are going, mid to high teens is what we're going to do on a gross basis, and you can, reverse engineer out of it. I don't know, Bill, if that's good enough for now. And what we can have separate conversations as we can kind of go through the math, and if anybody's really interested.
What sort of concentrations will you run per company and by industry within cannabis?
It's a great question. In terms of per company, I don't know if we've specified yet. The BDC has some interesting concentration limits. You can go up to 25% for each of 2 loans, and then the rest of the loans have to be 5% or less. So we'll have more flexibility than a BDC would. I don't envision going up to 25% in a private vehicle, but it could be up to 20%. I know that other folks do something like that. And then I don't think we have to limit ourselves to being 5% and under. So probably a little bit more flexible from the BDC, but we're very cognizant of geographic concentration of parts of the, we've seen some people lend in the cultivation side, which we're not completely against, but we're very cautious on. And we've seen some people, especially in real estate loans or whatever, doing lending to certain parts of the value chain. Or I mentioned limited license states where they say there's never going to be another license in the state, and then 10 more or 20 or 50 more get issued. So we like to have diversification within the borrowers, right? And that makes it a little hard because people say, well, where are you by state? Well, some of these folks are in the bigger private companies are in multiple states, but we're very cognizant of states and the competitive dynamics in each state. That's one of the things that takes so long to underwrite these.
Mr. Gold is asking, what commitment are the SS partners making to the new vehicle?
We'll do a standard. We'll have a standard, and Mr. Gold's. I know Mr. Gold well. He should call me afterwards. We'll take on more of his communities. Thank you for the support, Mr. Gold.
Yeah.
It'll be standard. Once this thing unfolds in terms of as we did with the BDC. You'll see a meaningful commitment from the partners for the private fund as well.
All right, and Mr. Gold had one last question, which I have to answer it on the webinar, but he can call you separately about commenting on federal versus state law concerning cannabis, since you guys know each other. Is that okay? Do a follow-up call. And Mr. Wong has kind of a similar question to one you already answered, which is how do you prevent conflict of interest between the public and the private?
Which hopefully we addressed.
Yep, I think we're good there.
Awesome.
I don't see anything else. Everybody who's still on, I put to everyone Bill and Frank's email. So bill@silverspikecat.com and frank@silverspikecat.com. I'm going to thank everybody. You guys have been good sports. I've done this a lot and I've never seen that many questions. So to be able to answer that many was pretty fabulous. And it was just so great to see you guys again. I want to thank you very much.
Thank you very much, Wendy. Really appreciate it. And please, to all listeners, feel free to give us a holler anytime. Happy to engage on this super, super exciting topic.
Yeah, thanks everyone for joining us. And Wendy, fantastic job. Thank you for everything. It was like the lightning round. I felt like it was the lightning round.
I know, that's what I said. I've never seen that many questions pinging.
But we got through it.
Great.
Fantastic.
All right. Well, great.
Thanks, everyone.
Everybody, thank you so much for sharing your afternoon with us. We really appreciate it. And we'll see you back at the next seminar. Thank you, Frank. Thank you, Bill.
Thanks,
Wendy. Bye-bye.